The silver market has entered what many analysts are calling one of the most extraordinary periods in modern commodity history. In a dramatic move that underscored both the fragility and intensity of current market conditions, silver prices surged sharply on Friday, jumping more than 6% in a single session and reclaiming the psychologically important 80 per ounce level. The rally followed a volatile week marked by record highs, sudden pullbacks, and renewed concerns about global supply shortages, monetary policy shifts, and rising geopolitical tensions. As of late Friday morning, spot silver was trading near $80.05 an ounce, erasing losses seen earlier in the week when prices briefly dipped into the low $70 range. The rebound was swift and decisive, reflecting a market that remains extremely sensitive to economic data and global developments. At the center of Friday's move was a weaker-than-expected U.S. employment report, which showed that the American economy added only 50,000 non-farm jobs in December, far below both market expectations and recent monthly averages. For investors in precious metals, the implications of that data were immediate. Slower job growth reinforced expectations that the Federal Reserve may accelerate interest rate cuts in 2026, a shift that typically supports non-yielding assets such as silver and gold. With real interest rates likely to decline, the opportunity cost of holding precious metals diminishes, making them more attractive to both institutional and retail investors. But the surge in silver is not being driven by monetary policy alone. Beneath the surface, deeper structural forces are reshaping the market. Global silver inventories are tightening at an alarming pace. Physical supply is increasingly fragmented, and industrial demand continues to expand, driven by clean energy technologies, electric vehicles, artificial intelligence infrastructure, and advanced electronics. At the same time, geopolitical uncertainty has added another layer of urgency, pushing investors toward hard assets as traditional financial markets grow more unstable. The events unfolding in China have added fuel to an already overheated market. Earlier this month, China's only pure-play silver investment fund, the UBS SDIC Silver Futures Fund LOF, experienced a dramatic reversal. After weeks of explosive gains fueled by speculative inflows and global silver enthusiasm, the fund fell by the maximum daily limit of 10%. The decline prompted rare public warnings from the fund's management, which described the recent rally as unsustainable. The fund's extraordinary rise had become emblematic of silver's momentum. Over the course of the year, its value surged nearly 220%, while Shanghai-traded silver futures climbed approximately 128%. As prices raced higher, the premium of the fund over its underlying assets ballooned from just 7% at the start of the month to nearly 62% at its peak, highlighting extreme speculative pressure. In response, UBS SDIC Fund Management announced new restrictions aimed at cooling demand. Limits on new Class C share subscriptions, the class most popular with short-term traders, were sharply reduced, a move that effectively throttled fresh inflows. The decision followed 3 consecutive days in which the fund hit its maximum daily gain limit, a rare occurrence that underscored the intensity of investor interest. These developments in China have had global implications. As one of the world's largest producers and exporters of silver, China plays a central role in the global supply chain. New export restrictions introduced earlier this month have tightened availability in international markets, forcing buyers to compete for fewer shipments. The impact has been particularly pronounced in Western markets, where inventories were already under strain. London, long considered one of the most important hubs for precious metals trading, has seen silver stockpiles thin to unusually low levels. Throughout 2025, significant volumes of silver were transferred from London to New York amid concerns that the United States could impose tariffs on imported metals. The result has been a fragmented global inventory system, with regional shortages becoming more common and pricing increasingly volatile. Analysts warn that this breakdown in unified inventories has made the market far more vulnerable to short-term squeezes. When supply is tight, even modest increases in demand can trigger outsized price moves. This dynamic has been evident in recent weeks, as silver has swung sharply in response to economic data releases, policy comments, and geopolitical headlines. Geopolitical risk has become another powerful driver of silver's ascent. Tensions in the Middle East have intensified, with renewed instability linked to Iran's regional influence and ongoing developments involving Israel. Heightened U.S. military coordination with allies and continued sanctions pressure have raised concerns about energy security and trade disruptions, prompting investors to seek refuge in safe haven assets. Beyond the Middle East, U.S. actions in Latin America, including renewed pressure on Venezuela, have added to global uncertainty. These flashpoints, combined with broader concerns about global growth and political stability, have reinforced the appeal of precious metals as hedges against systemic risk. Silver occupies a unique position in this environment. Unlike gold, which is primarily a store of value, silver straddles the line between investment asset and industrial commodity. In many past cycles, economic slowdowns dampened industrial demand, limiting silver's upside. This time, however, the story appears different. Demand from solar panel manufacturing, electric vehicle production, and AI-driven data centers continues to rise, even as growth in some traditional sectors slows. Silver's exceptional conductivity and durability make it indispensable in these technologies, and there are few viable substitutes. As governments and corporations accelerate investments in clean energy and digital infrastructure, silver consumption remains robust. The rally in silver has been accompanied by strong gains across the precious metals complex. Gold prices climbed more than 1% on Friday, trading near $4,114 an ounce, while palladium and platinum also posted notable advances. Commodities that do not pay interest tend to benefit from lower borrowing costs, and with traders increasingly betting on further rate cuts in 2026, the entire sector has found support. The role of public commentary has also been notable. Over the weekend, remarks by Elon Musk highlighting growing investor frenzy around precious metals drew widespread attention. Responding to a post about Chinese export restrictions, Musk described the situation bluntly, saying, "This is not good." His comment, shared widely across social media, appeared to add momentum to early week trading, reflecting how sentiment can now spread rapidly in an interconnected market. Looking ahead to 2026, major financial institutions broadly expect silver prices to remain elevated, though opinions differ on how high they may ultimately go. At Citigroup, strategists forecast silver averaging between $60 and $72 per ounce next year, while warning that physical delivery shortages could intensify. Under certain scenarios, particularly if monetary conditions ease faster than expected or industrial demand accelerates further, Citi sees potential for prices to spike toward $100 to $110 per ounce in the second half of 2026. Goldman Sachs has taken a more bullish stance. The bank projects silver trading in a range of $85 to $100 per ounce in 2026, describing the metal as a strategic asset rather than a cyclical trade. Goldman analysts point to years of underinvestment in mining, limited new supply coming online, and silver's critical role in the global green transition. Even moderate global growth, they argue, could be enough to sustain strong demand, while any further rate cuts would add an additional tailwind. Despite these optimistic forecasts, analysts caution that volatility is unlikely to fade. The silver market remains relatively small and less liquid than gold, making it prone to sharp swings. Profit-taking unexpected policy shifts or sudden changes in global growth expectations could trigger rapid corrections, even within a broader bullish trend. For now, the reclaiming of the 80 per ounce level stands as a powerful signal of how tight and reactive the silver market has become. With inventories at historic lows, supply chains under pressure, and macroeconomic and geopolitical risks still elevated, silver is poised to remain one of the most closely watched commodities in global markets. Whether this period ultimately proves to be a sustained structural revaluation or a volatile transition phase, one thing is clear: silver has reasserted itself as a critical asset at the intersection of finance, industry, and geopolitics. For investors, policymakers, and industries alike, the coming months may determine whether the great silver squeeze of this era becomes a defining chapter in modern market history.